Holy smokes, everyone. So I'm sure lately you've been seeing a lot of videos that the stock market is just about to crash or about to see the biggest bubble meltdown in history. But despite all these warnings from the experts, the stock market just keeps rising higher and higher. This is leading many people to think, what's going on in the markets? Why are we at all-time highs when there is so much uncertainty and such high unemployment in the real economy? Well, that's exactly what we're going to go over today, because there's some huge new information that explains exactly why the stock market has become so disallocated from reality, and we're going to go over why it hasn't crashed and some new information that could tell us what's about to come in the future. And this information couldn't come at a more important time, because in the markets right now, we're at euphoria. Everything is euphoric, everything is at all-time highs, everything seems gravy and rock and roll, but unfortunately, it's when you least expect it that disaster strikes, just like in 2020. Okay everyone, let's not waste any time, let's get straight into it. So look at this everyone, record stock sales from money-losing firms ring the alarm bells. This is some new important information that we're going to go a bit more in depth in a moment. This is one of the many reasons, so I'm going to get into today, why the stock market hasn't crashed, just because you've got many investors that are simply bailing out all these zombie companies that should have gone bankrupt but haven't, because they've been issuing stocks like crazy and investors have been gobbling them up. And it's not just this. This is also because the Federal Reserve in 2020 did something which is not part of the Federal Reserve Act, something they're not normally allowed to do. Instead of buying government debt, government bonds, US treasuries, they got permission from Congress to start buying corporate debt. And not just corporate debt or corporate bonds, corporate junk bonds. So normally what would happen in a financial crisis like in 2008 is companies would go bust. They would try to issue IOUs or try to raise money through issuing bonds. But in a normal free market, investors won't want to touch them because they know that the company is going to go under. So what happened is the Federal Reserve says, you know what? No one else is going to buy it. Well, we'll just get money from the taxpayers and we'll bail out all you companies and buy these corporate bonds. I just love bailing out the billionaires. So listen to this everyone. If you think a rush by companies to sell their shares is a bad omen for the market, imagine a scenario where most of the sales come from firms that don't make money. What the flippy flip flap flop's going on everyone? So you don't even need to make money in this market anymore. You know what? As long as you got a logo and say, look guys, I want to change the world and we'll make money one day, well that's good enough. Here, shut up and take my money. Not to mention with the rise of index investing or ETF investing, a lot of investors are buying these zombie companies without even knowing about it through investing in these indexes. For example, like the S&P 500 or Vanguard has a VTI, that's just a total stock market ETF where you can literally buy every company listed on the US stock market exchange. And listen to this everyone, it's happening now. Since the end of March, almost 100 unprofitable US companies, including GameStop Corp and AMC Entertainment Holdings, have raised money through secondary offerings, twice as many coming from profitable firms, according to data compiled by Bloomberg. So look at this chart everyone. This is the supply gut. Money losers are flooding the market with secondary share offerings. So we can see the black line here, that's profitable firms with secondary offerings, and the reddish pink lines here is unprofitable firms with secondary offerings. And as we can see, since 2020 and 2021, there is a huge increase of unprofitable companies issuing shares in a secondary market. It says here, granted, troubled companies are tapping into buoyant demand during a 16-month rally to beef up their balance sheets, and as further evidence that capital markets functions as smoothly as it's supposed to. Yet some warn that the flood of shares coming from money losers is becoming extreme. During the past 12 months, almost 750 money-losing firms have sold shares in the secondary market, exceeding those that make profits by the biggest margin since at least 1982. And this was when data compiled by Sundial Capital Research shows. And I bet some people think, oh, this is going to be great. Companies are going to invest. They're going to become, really innovative. I'm sure what's actually happening is a lot of CEOs are stashing their pockets right now. Okay, and this is huge, everyone. You have to have a look at this, and this has predicted all market crashes in all bear markets. So have a look at this one indicator here, everyone. In fact, the previous two periods in which unprofitable firms dominated the pool of equity offerings, the S&P 500 index was either at the start of a bear market or already in one. Look at this chart, everyone. Look what happened here in 2000 and in 2008. There is more money-losing companies that are doing these share offerings than profitable companies. And when we've hit these levels, like I said, was in 2000 and in 2008. So there's so many indicators, so many red alarm bells going off that went off in 2000 and in 2008 that are going off right now, and we'll get into those in a moment. Because look at this, everyone. Another indicator that predicted the crash in 2000 and in 2008 is also flashing red. Margin debt. We can see here when margin debt peaked in 2000. Again, the red line is margin debt and the blue line is the S&P 500. Then we saw a big correction. Then we saw a run up in margin debt in 2007, and then another big correction. And look where we are today. Margin debt is at all-time highs, and I think a big correction is just around the corner. But wait, there's more. Look at this, everyone. Again, I keep showing you this, but this is very important. PE ratios have never been higher in history. They're higher now than in the dot-com bubble. We can see here in 2000 they peaked. There was a technical glitch, in 2008 they spiked to like 135, but that was just one quarter, so we won't really include that. But we can see here, price to earnings has never ever been higher. It says here, the 2000 episode showed what might be at stake. Back then, a similarly ebullient market lured profitless companies to offer shares. Once supply overwhelmed demand, the party turned into a scare. Stocks with no fundamental support sold off, and the carnage spread to the rest of the market. And what are we seeing right now in the markets, everyone? We're seeing very speculative assets selling off, like the SPACs, like the NFTs, like cryptocurrency. It's a very speculative asset, and they're normally the assets that sell off before we enter into a broader bear market across all other assets. We're also seeing speculative commodities like lumber crashing as well. So once these markets crash, and then they start to crash to such a level, it starts to affect more of the fundamental markets, like, for example, precious metals and stocks. It will just be a matter of time before we see this carnage in these speculative assets start to flow into more safe haven assets. But this is really what's causing this huge bubble, everyone. Listen to this. There can be too much money chasing too little good deals, said Janet Garrity, chief economist at Robertson Stephens Wealth Management. When the good deals don't need money, they start looking for less great deals, and then down the road, this is what lead people to get their fingers burned. And this right here, everyone, this is a reason why the markets haven't crashed. Because look what happened in 2001. The M2 money supply grew at a growth rate of 27%. That's right, 27%. So people had no choice but to invest their money. And what we're having is really an oversupply of cash. We're not really having a shortage of, great assets or great deals. We're having too much money chasing too little goods and too little good deals or investments. That's why we're also seeing real estate go crazy because of all this cheap debt in the system. It says here, Sundial tracks a suite of indicators to gauge the market sentiment. That money-losing firms are flooding the secondary markets adds to a growing set of signs that point to elevated enthusiasm, according to Jason, the firm's founder. That's right, people in the stock market, they're feeling invincible, they're feeling super bullish, and this, arrogance or this complacency is why people are still piling into the markets at all-time highs and why we haven't really seen a sell-off yet. But listen to this, everyone. When there is increased appetite for issues from unprofitable companies, it tends to mark a point of euphoria. This phenomenon can be in place for a very long time. It's not necessarily a signal that the market is about to reverse, but it is something that typically has preceded a period of reversal in the trend. The market is more likely to cool down when the appetite for unprofitable issuers rises. So everyone, it's because of this euphoria and the money printing by the Federal Reserve, and also for them ignoring inflation, because right now the official CPI number of inflation is 5%, but Shadow Stats has inflation, real inflation, around 9%. And the reason why it hasn't crashed and why I thought a crash would be coming around now was because I thought the Federal Reserve would do their job and lift interest rates when inflation got out of control. But no, they're not addressing the problem. And what I think is going to happen is they're going to continue, to close their eyes, cross their fingers, and hope the problem goes away. And hey, it may look like inflation will go down because, when prices rise, 100%, and for example, they fall 50%, the Fed will say, look, I told you it was transitory. We won't lift interest rates. But really, prices will still be up 50%. And so this is forcing people to invest in the stock market, because if they put their money in the bank and they're only getting 0.5% of interest and inflation's 9%, well, they're losing 9%, so they're forced into speculative assets like the stock market. Now, this is great in the short term, but what happens once all the money is in the stock market? What happens once everyone maxes out the debt? Because this is a debt-fueled economy, not a real free market economy. It relies heavily on debt. And what's coming up soon? Well, there's a debt ceiling for the US, or the supposed debt ceiling, and they're going to be negotiating on that. So we're having a lot of signs of M2 money supply decreasing. We're seeing crazy speculation in the markets. We're seeing more and more risks build up. And all it's going to take is for one policy mistake, or for inflation to get out of control, or another black swan event, because the markets are dancing on a nice edge and they're so fragile right now. All it takes is just for some official to mention they're going to taper, to mention they're going to stop printing, or they may increase interest rates, and then we see them start selling off straight away. And something that I may think could also be coming, or could also be a risk, is a lot of companies' earnings have been great because of all the stimulus checks that have been coming out, and people have been making more money from unemployment benefits than the actual jobs. And also, they haven't been paying their rent or paying their mortgage, so they got more money to go out there and spend on these companies' products. But the stimulus is being taken away, and people are going to have to start paying their rent again and start paying their mortgages again. And so then that's going to make these price to earnings values ratios even crazier. And then a correction is going to have to come in once these earnings drop. So everyone, what this means is, I'm not saying, that the market's going to crash tomorrow, next week, next month, next quarter. Nobody knows exactly when it will crash. But what I am saying is there are lots and lots of risks building up in the stock market at the moment. I'm not telling you to sell your stocks or try to time the market, because like I said, nobody can, but really putting your money in at the markets right now is a dangerous time. And you have to think to yourself, what's more likely, the stock market going up 20% this year, or for us possibly entering into a bear market where it falls anywhere between 15 and 20%. Now you may think this is all doom and gloom, or I'm all doom and gloom, but I actually have money I'm waiting to invest, and I'm an investor myself, and I love investing, but I don't want to invest right now when I can see all the risks that are building up in the markets. But everyone, what do you think will happen to the markets this year? You let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. If you haven't already, please tap that like and subscribe button. I'll keep you up to date with the latest that's happening with the stock market, the housing market, and cryptocurrency markets. And if you're bored, I'll put up some of my other videos here. I'll see you all there.